Y'all doing? Welcome everybody. Um, let's get the cat out the bag, or let's get the elephant out of the room. I mean, where have we been the last 4 years? Well, um, this is my first public analysis session or trading content of any kind in about 3.5 years. Um, I got the emails, the social media DMs, and of course, those of you who have my personal details who've been in contact with me, let me know over the last few years how much you've missed us being online, how much you benefited from the content we were putting out, and therefore missed it. Um, I'll take 5 minutes and then we'll just move on. So, for those of you who don't know, I started trading in 2007. That's the first time I opened a trading chart, 2007. The first several years of that journey were very unprofitable. In 2008, I think I've told the story of how I, in one day, lost 20,000 pounds, which was pretty much well, it was my entire trading account. I think I was left with about 100 pounds, 100 something pounds left in it after that crash. As usual, I was gambling for many new traders. I was trying to call. In fact, when I look back, it was actually disgraceful because the worst thing that can happen to you when you don't know what you're doing in the markets is to win your first few trades, which I did. I had no idea what I was doing, but I won my first few trades, and I thought I knew. I thought I was the best thing since sliced bread. And then I became inconsistent, would win, lose. Many times I was trading without a stop loss. Ooh, just thinking about it. Uh, I was trading forex, I was trading stocks, I was trading ETFs. Um, no strategy. Literally, I'm see. Believe me when I say this. You may not believe me, but this is true. I would literally look at a chart and decide what direction I thought price was moving in, and then I would enter. Needless to say, this was a recipe for disaster, and disaster soon struck. I went from making little bits of money to becoming inconsistent, and in one day, I lost 20,000 pounds, and so I got burnt and I stepped away. And then about 2012 or thereabouts, I came back to the markets. And I think this happened in 2009 when I can't remember. Anyway, somewhere no, late eight. That was in about 12. I came back to the markets, and this time I went and I did my studies. So I did my homework and technical analysis, and I thought I was good. And probably I was. And I was a part of, um, so in a second, guys. So I was a part of a trading group. So hold on, sorry, what is going on here? Just making sure the sound's all right. And so I was a part of a trading group, um, and this particular trading group, or trading community, I should say, was full of people like me, budding technical, budding technical analysts who knew plenty of theory but were very inexperienced. But like me, were trying to keep up an appearance, and so nobody was being honest about the fact that we were all at best inconsistent or at worst losing money. We all gave each other the impression that we were all doing very well when none of us was doing very well. And under that pressure, now I was armed with technical analysis. Now the old stuff, trend lines, breakouts, that kind of stuff. But at least I had an idea what I was doing. But I was horrible with my mentality, horrible with my risk sizing. I remember losing $1,000 on $1,500 account on two trades taken on the same day. What I call the emotional analysis, to where I moved the stop loss from £100 to about £1,000 across the two trades, and I blew that account in about 45 days. And then I decided to learn how to trade the right way. I've told you guys my story, the people who I learned from, Chris Laurie, Inner Circle Trader, Michael Huddleston. On his recommendation, I went back to look at some of the stuff from Larry Williams. This was before SMC was a thing, right? This was long before SMC was a thing. Um, and I finally cracked how the markets worked. The problem now was, having cracked how the markets worked, I still needed to crack my psychology. And so I spent many long days, many long days, far longer than uh, far longer than is healthy, trying to refine what I had distilled into an actionable plan, uh, which I eventually did. Problem was, by the time I did this for 3 years, I'd become an excellent trader. And then I at the same time, took on the assignment to open Israel Keys Wealth Academy. I had friends and people, some of them from some of the community groups I'd been in, who were struggling trading, who were noticing that I was very proficient now. At some point, I was actually trading some money for some friends and family. They deposited with me off just a biological family and very close friends. So, um, anyway, cut a long story short, and I didn't realize trading was burning me out. I was on the charts all day, phone, laptops. Beyond that, many of you know I'm a preacher, a church leader. I had other things I was doing, but my stop burned too harsh, too hard, too bright, and I tapped out. I literally was emotionally burnt after 3 years of consistency with this new methodology. And it was around that time I decided to start Israel Keys Wealth Academy. So basically, 5 years in, 2 years into IKWA, I had no more to give. The flip side was, the more profitable I became, the more money I had, and the more successful I became at trading. The mentality is applicable to other walks of life. The same mindset you need to become a successful trader will make you successful at almost anything else. It just got to the point where I didn't need the money anymore. Um, I was charging rock bottom for my mentorship classes or my mentorship program. And as you can find out from this, I dare you just go through this YouTube channel. I've left nothing untouched, or nothing. I've left everything untouched. So unless YouTube's taking down a few videos, I don't know. I haven't taken down anything. You'll find out this is the free content. This is my YouTube channel. It's open to the world. And look at how much I put into it. The teachings, the analysis, the podcast, the live trading, the live mentorship. You know, this was what was free. Now you can imagine, if this was free, you can imagine what I was giving my students off camera. And I'm not one of those gurus who was pretending to be able to trade. You never saw me post a Lamborghini or helicopter. I was never a millionaire from trading, but I could feed my family. I could live a good life, and I could generate some money to put into some other things that were nowhere near as emotionally demanding as the style of trading I was doing. So I decided, one of my sons was moving to a new phase in school, and the London session clashed with the school run. I wanted to spend time with him on the way to school and also back. In essence, London was the school run going, New York was the school run coming back. I just thought, take a week, take a year, take 12 months, a sabbatical. And that turned to over 3.5. Because just as I thought, okay, it's time to come back, I then moved my family, our primary residence. We still split time in the United Kingdom. But I now personally live predominantly in Lagos, Nigeria, which is the city in which I was born. No, not born, but city I grew up in. And that's been a 2 year crazy ride. It was 2 years in August this year. And so only now do I feel ready and actually motivated to come back to the market. So I'm not just ready, I actually want to come back. And I thought to myself, what better way to. So up until last week, I hadn't taken a single trade. I hadn't taken a single trade in 3.5 years. I still haven't taken a live trade. I have done analysis and paper trading. And so I'm going to be honest, for the next few weeks, these analysis sessions are going to be as much for me as they are for you. For those of you who said you want them, a couple of my old students interestingly reached out to me this past week, around about the same time I was getting back in the charts. I thought that was extreme divine serendipity. and we've been talking off camera, and I've been sharing some of my analysis and setups with them, and they've been trading through my hiatus. But they amazed, or they were amazed, humbly speaking, about how uh, helpful my analysis and my insight was to them. So I thought, hey, this week's trading journey, I would try and capture online as much as I can. I'm not promising quite yet that I can put in the same schedule I was before, because that was obscene, especially for a free YouTube channel. In hindsight, that was crazy, and I probably will not do that. But I will do some, enough for you to be a beneficiary of. And primarily for me, also, my kids are now at the age where they can learn to trade, and one of them's asked me to teach him. And so I'm going to be doing this just as much for me as I am for him. All right, I've probably spoken far too long, and maybe I should have put this in the Traders podcast. But anyway, let's get to it. Right, let's get to it. So let's just put my now what I've already done some marking up of my screen, of my chart. Sorry, I should say. So what I'm going to do is, right, let's do it this way. Okay, so what I'm going to do is, rather than show you what I've already done, I'm going to pull up a fresh chart, or fresh set of charts, and just take you through the process that I taught you, for those of you anyway who were around a couple of, or more than a couple of years ago now. So I've already done some quote unquote private analysis with a student already today, but I'm going to go from the beginning. Right, so something about that chart doesn't look quite clear. Okay, cool, it is clear. It is clear. All right, so let's do this. So these are some of the annotations I made in talking to one of my old students today. But let's go through what I call the pro traders approach. Now, of course, I'm only going to deal with technical. All right, sorry about that. Some technical issues here, but let's get the charts back up. It's the first time I'm doing this in almost 4 years, so makes sense I'd have some hiccups, but let me get MetaTrader back. So basically my computer just kind of froze its connection to the dock I'm using to, okay, good, using to run multiple screens. All right, let's get this back up. Awesome. So, I forgot to mention. So, the good news is, first of all, before I go into the analysis, first of all, the academy's coming back. And I hope that's good news for many of you. So, this is what we were running as at when I had to step away. It's pretty much coming back. So everything you see on your screen, the Market Breakers course, the VIP mentorship, and the Mastermind Inner Circle, 3 different layers. If you pay for the one to the far left, you get everything to the right. So if you get the Market Breakers course, you get VIP mentorship. No, you get everything. Sorry, you get everything. If you get the VIP mentorship, it's different from the mastermind in the circle. But I'll explain all that some other day. Amen. And for those of you wondering how serious was our schedule, this was our free schedule. So this is what we were running as at 4 years ago. You see, I was pretty much on charts with you every day of the week. Crazy. And the only times on this thing that were not open to those of you on YouTube were Wednesdays, Thursdays, and Sundays. So you got me Monday, Tuesday, and Friday for free every single week. I don't plan to do that again. All right. So, also, I've just finished in the last couple of weeks while getting ready to come back to the markets full time, finished 2 books on trading. I don't have them here, but I'll show you. One of them is called Learn to Trade the Right Way, From Candlesticks to Profit. And the second one is, what did I call the second one again? Give me a second. I can't remember what name I gave it, but it's basically me breaking down everything I've learned about trading like smart money in the markets over the last 10 years or so. Been trading since 2008. Been trading like smart money since about 10 years ago. I break it down. Like for the first one, it's more of a generic book. It talks about mentality, risk management, it's more theoretical, but there's plenty of practical examples in it. So it's more teaching you a methodology to approach being a trader and how it works, all the way down to the technicals and analysis and fundamentals and everything. The second one is purely technical analysis, purely smart money concepts. It is the how to do what I'm about to show you today. It talks about everything: order blocks, breakers, fair value gaps, a market structure break, supply demand zones, liquidity sweeps, liquidity. It basically said if you go through both books, by the end of the first one, you should be profitable if you follow it, but the second one should make you a great trader. All right, so now that I got out the way, so part of my analysis is I usually go with, I will usually start with some brief, light fundamental analysis. And usually, if I do it at the start of a quarter, I only ever need to check every week that my existing analysis is still valid. But I'm not going to bore you with that today. We're just going to go straight. So this is my chart. Okay. Right, that annoying sound. Okay, yeah, that noise sound is the ADR indicator, average daily range indicator. So just going to get it off the chart, and then that should be fine. All right, you will see whenever I use somebody else's indicators, I usually like to give them credit. Some of the stuff I'm using on my screen, this KPI indicator, I've forgotten whose it is now, but I do know the average daily range indicators from Michael Huddiston, aka Inner Circle Trader, who many of you know. So it's going to break it simply. I'm going to try to do this as simply as possible, right? As simply as possible. Let's go. Depends on, now I'm going to be executing my trades on a 15-minute chart. So the highest time frame that I really need to worry about with my analysis is the weekly chart. Now, I will do the monthly just to give me an idea of what price is doing from that perspective. And remember, price is fractal. It behaves the same way in every time frame. Now, there was 4 years ago, I was trading primarily off, well, mostly off the 1 hour, and therefore I would start with a monthly. But since I'm going to be taking entries on the 15, the weekly is pretty much where I start my analysis. But it's always good to look at the monthly. What's price doing? So this is EUSD. I will usually start with the dollar index, the USD index. But to make this brief, I've done that already. I know what it's doing. I'm just going to show you what it looks like on an actual currency pair. This works for ETFs, indexes, NASDAQ, gold, silver, wheat, oil, futures, options, you name it, it works just the same. The only thing it doesn't really not well, the only thing it doesn't 100% map up to is stocks because of the difference in liquidity. So it's still the same concepts, but I wouldn't use my concepts to trade stocks blind because it's a slightly different game because of the liquidity. But that's about it. Right, so here we are. What's happened? Over the last 2018 is going back 7 years. What's happened? Downswing. Upswing. All right? If we push back, we can see that we're in a long-term bearish move on EU USD. So this is a retracement, right? Just get your feet wet. This has almost nothing to do with what we're going to look at, but it's a retracement into this zone right here, right? We see a fair value gap here, which is a sign of strong displacement. See, price in this candle never came up to touch that one. So you could say, right, strong displacement. Now, price came back to violate it. That's fine. It came back to the order block. That's fine. And for those of you who wondered the difference between the two, price can choose which of the two it respects. They're both, the fair value gap is a sign that there was a strong displacement. It's not a guarantee that there will be liquidity or enough liquidity there. Look, it came in, respected it, and then pushed out of it. Bear in mind, this is a monthly chart. And then came back up to the order block, right? And then fell. You'll see this at every time frame. Either of these are fine. And if you want to be conservative, just put your stop loss beneath the high or the low anyway. And then we have another downward leg. This is in itself a form of fundamental analysis. Now you can do what I'm doing now by looking at what's been happening in news, but this is a form of fundamental analysis. You're looking at long-term moves. All right. Well, it's not predictive fundamental analysis. It's forensic fundamental analysis. And then you can see we're making higher highs, higher lows, right? Until we get here. If you remember what I taught you guys about how price moves from consolidation to manipulation to expansion, and then in expansion you have retracement and then target, we know that price begins the cycle at consolidation. Whenever you see consolidation, think new price action cycle. If it's on a intraday time frame, you're thinking Asia, the Asian range, for instance, and in between session openings. If it's weekly, you're thinking either Monday and or Friday. If it's swing, you're thinking beginning and end of the month. And if it's long-term trading like this, you're looking at entire periods of the calendar, right? And how do we know price is consolidating or contracting? You will either have a clearly defined range at which highs and lows form for a significant period of time relative to that time frame. Or you will have, now this is where the shape patterns for the pattern traders come in. You'll have a wedge. The price doesn't respect your wedge. The wedge is simply a means you can use. So this is one example. Horizontal lines of range forming, the price stays in. Or if you want to draw a wedge, by all means, go ahead and do so. Right? It means lower high. So either equal highs and lows, fairly equal highs and lows, or lower highs and higher lows. But in essence, price is stuck in a range. There you have it. And then the range breaks out. That's what you call the expansion. But there is always a manipulation to the expansion. Almost always, anyway. And I'm going to show you that here. So keep that on the screen here, right? I'm going to take these off just so that you can see the candles in that range. If you're wondering, get to the 50, dude, that's why you lose money, right? Be patient. This is how you, if you know this, please be patient for those who don't. Okay, so this consolidation is either signifying a reversal or a continuation. In essence, it's either a pause to continue the already established direction of price, which in this case is down, right? From the first of, no, actually, so yes, from here, from the 1st of July 2008, we've been in a downward trend, in a macro downward trend on EUSD. Just think about that. If you sold EUSD on the 1st of July 2008, and this is how banks think, this is how institutions think, this is how proprietary hedge funds think, this is how the superstar traders think. Sadly, it's not how you and I think, which is why many of us lose money. And of course, we can't trade like this because we're not them. We don't have the tools or the resources. But we need to understand how they think so we can correctly trade with them. All right? Cool. So, if you put in a trade on the 1st of July 2008 and you took your profits on the 1st of September 2022, you would have made 6,380 pips. Let that sink in for a second. And even if you were closing today after weathering the drawdown, you would still be 4,000 pips up. If you are trading a full standard lot of $100 per pip, that would be $400,000 in profit. Think about that. If you traded 10 lots, you'd be 4 million up. If you traded 100 lots, you'd be 40 million. Just sitting through all this noise. Right? Okay. And if you know anything about fundamental analysis, technical analysis and, smart money concepts, you know that you literally could have just targeted these lows, come out in profit here, and from July 2008 till roughly December 2014 or November 2014, you would have made 4,000 pips. Now we are in a consolidation. Have we seen consolidation in this move before? Yes, we have. Right here. Look at that. If you want to draw the wedge, be my guest, although the wedge doesn't really work here. But if you want to draw the wedge, especially with the bodies of the, be my guest. That's a wedge. That's a consolidation. That's a contraction. Don't trade it. Just use it to help you recognize that the market is in the consolidation phase. If you, like me, prefer to use vertical lines, again, you don't necessarily need to trade them. Be my guest as well. Whatever works for you. I'm not going to prescribe to you how your brain works. If you want to take the wicks, fine. If you want to take just the body, fine. Whatever you need to do to show you what price is doing to line up with the framework through which you view price, as long as your framework is correct. All I care about is your framework correct? If it's correct, how you identify it does not mean a can of beans to me. So that's another way. Come on, MetaTrader 4. Sorry, I've still not gotten on the trading view revolution. I soon will. Right, so there you go. That's a consolidation, right? Whenever you see a consolidation, think continue or reverse. And usually there is a manipulation. Not always, but usually. Now, here, back here, this was a continuation. But how did price react to the consolidation or the contraction before it continued? By a manipulation. How? It was going to go down, but it first took out market structure and liquidity to the upside of the consolidation and then pushed down back into the consolidation. Now, it could very well have done this. Sometimes you see this just pushes straight through it. But sometimes it needs to engineer some liquidity to go back and pick up some more orders. And then it pushes here. How can you tell the difference? There is nothing certain in the markets. This will not work for you 100% of the time. But 70% of the time, just do what I call a strength analysis. What do I mean by strength? Well, we're breaking out of consolidation here. Now, because this is the monthly time frame, we don't have higher time frames, at least not on MetaTrader, because you could do this by looking at the trend or the price action on a higher time frame. But this is a monthly time frame, so let's assume you can't do that. Well, very simple. How did we break out of the range? We broke out of the range with a fair value gap, as you would expect. If you don't know what a fair value gap is, you need to watch some of our other content. That's the fair value gap here. Three candle, let's blow this up. A 3-candle pattern in which usually when price action is efficient, you see that the highs and lows of alternate candles touch each other. Look at this, for instance. See? The low. Oh, come on, okay, let's draw this out. The low of this candle and the high of this candle touch. You see, it happens all the time. This one and this one. Not quite this one. You see, there's a gap there. So fair value gaps mean that price did not efficiently trade through certain price ranges. In essence, buyers and sellers didn't have equal chances at exerting influence before price chose one direction. One side completely overwhelmed the other. It's a sign of momentum. It means things are moving. And when you see fair value gaps at key levels and forming key patterns like order blocks and liquidity sweeps and all these things, you can trust them. The issue is the third candle on this fair value gap was an indecision candle. Look at that. When I trade fair value gaps, I'll give an example of a good fair value gap here. It means you can trust the direction of the gap. Look at this, right? 3 candles, all of the same color, same direction, and they're all what you call strength candles. There's no doubt who was in charge in this month. The bears were. This month, the bears were. This month, the bears were, right? So this is a strong fair value gap. It's so strong sometimes it never gets revisited because price just blows straight through it, especially if it forms other fair value gaps along the way, like this one, for instance. This is one from here to here. That's another one. You see, all the way across this move, all we're seeing is fair value gaps left, right, and center. They're all one-sided. They're strong. They're all in the same direction. And they're no indecision candles. When you see a fair value gap with the last candle being an indecision candle, so we see this. We pull back to the fair value gap, which is what you would expect, and price moves. Now, I want you to imagine you were here. This would have been... I want you to imagine that you were here looking at this in 2017. At the end of that month, you would have seen a first fair value gap here as price broke out. That's one, right? It's a very small one, but it's there. And then you would have seen this candle form, which is a big fair value gap. Now, if this was a 15-minute chart, I'm not trading it. But it's a monthly chart. This would have been a good setup to go long here, because over the next, this is how it works. Over the next 6 months, there was a bullish move in the dollar. First of all, you could have traded. This indecision tells you that this expansion is going to retest, which is what you want. If you're a position trader, let me show you what you could have done as a position trader. If you're a position trader, you can simply put your stop here. Enter there on the re-entry to the zone and the come out. So basically a stop entry, not a limit entry, a stop entry, meaning price has to come into the zone and come out. Your stop loss would have been 250 pips, which is not bad for a position trader. And in 1 to 3 months, which is very good for position trade, you'd have made 1 to 3.5%. That is a valid trade because you're on a monthly chart. It's going to be long enough. And if you stopped, that's 1 second. So I'm just going to put this actually now because going back to 2017 is going to be almost impossible. But if you looked at this piece of price action on a daily, weekly, and 4-hour chart, you would have gotten 6 months of good trade setups. However, this fair value gap doesn't fill me with confidence. And what do you know? It becomes an inverse fair value gap because it's the basis for a monthly liquidity run. Look at that. Some of y'all call that a turtle soup. You see that there? Why? Because price was using that breakout to tap back into previously unused price action. There we go. One of my favorite patterns in all of trading. Indecision candle followed by very strong directional momentum that causes a strength fair value gap. Right? See that there? Cool. So that's the fair value gap. That's the order block. Price chose to respect the order block. That's fine. And then there is a push down in the original direction. And when we're gapping or when we're coming down, you will see what I call strength. Okay, so not so much here. That's fine. So this fair value gap ends with indecision, which is why, so that's fine. No issues here. In essence, this is telling us it doesn't have the momentum. It hasn't picked up the liquidity it needs to run. So what happens? Institutions pull out their orders, let price dance back into the zone, right? But again, you can see the fair value gap up here is still not as strong as I would like. That's an indecision candle or rejection candle, followed by this. And then you have this to this to this. A bearish candle, one-sided. But once it's picked up what it wants, look at the strength with which it comes down. Right? Look at the strength with which it comes down. However, while this has more momentum than this, it's still not what I would like to see. It's still not the textbook I showed you earlier on. that tells me long term on the monthly chart, so this is years, that this downward move we've seen for years is starting. For instance, look at the fair value gaps we're seeing here. Look at this. Textbook ones. Here, pitter patter. Here a bit better because it's reloaded with liquidity, but still not as textbook as this. Could it be? I don't know for a fact. But here's another consolidation. Could it be that this move has run its course? You will also notice that at least on MetaTrader, historically, there is no context on the charts on MetaTrader for us down here. We've never been here before. Secondly, if you know anything about the way smart money works, and if you've listened to me over the years and other trading mentors, ICT being one of them, full disclosure, he was my mentor for a very long time. And I don't mean personally, I mean from afar. You will notice that this is what we call clean highs. Two highs visibly or visually close to each other on a chart. Also, even if this is just a retracement, this is above 61.8 on the Fibonacci chart, Fibonacci tool. So even if we're going further down, it would make sense for price to retrace, to sweep this highs to this rough level over here. Wouldn't you say? Actually, one second. Let me draw this chart the other way. Let me draw it the other way. This Fibonacci tool. Again, I can do this in 5 minutes. What I'm showing you now, I will do this in less than 5 minutes if I was trading on my own. I'm just trying to carry you along with me. So when we get down to the lower time frames, you understand why I'm not screaming like you are about the markets going this way and that way. So this would be roughly the 71.8 thereabouts. This is where I do my Fib tools. Is it on? I mean, if you're just a normal technical trader, if you don't know anything about SMT and smart money concepts and liquidity and all this kind of things, you just trade Fibonacci levels. Well, doesn't this make sense? Somewhere between 61.8 and 61.8 and 72. Let's just call it 72, right? That would be a 38.2 or 23.6 retracement. Somewhere here would make perfect sense, wouldn't it? And then even if the market's going to continue going south, this is a normal level. One, you have, and for the SMC traders among us, smart money traders, you have a liquidity target here. And this is 2 monthly highs side by side. The market's going to have a swell time if it gets there. There's no guarantee to get there. Secondly, you would have two different fair value gaps here in this level. One of them here and the other here. Right? So, what if we see this? Again, I'm doing this on a monthly chart. You can do this on any chart and then go down to a lower time frame. I'm just showing you how you can do fundamental analysis technically. And you can go and look at the interest rates and open interest and central bank policies, and you get the same thing. But this is the picture. So with this, on the alternatively, right? And the beauty about doing this on a monthly and a weekly chart is there's plenty of room for error because it takes so long to play out. What if price is just doing this? Sorry. What if it's just doing this? Right? What if that's all it's doing? The range is engineered liquidity. In essence, it would have cleared these two intermediate highs And again, they look small on an hourly chart, on a monthly chart, sorry. But these two highs are literally 27 months apart, right? Into a deep retracement. And oh, by the way, what do you have here? Well, you would just happen to have an order block, wouldn't you? An order block, right? If you wanted to take the two candles together, that's even better. It means we're already in there. And what happened after the order block? Well, there was strong momentum, strong engulfing, and a very, 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 actually, I can't even, yes, there's a tiny, I'm not even going to take it because, yeah, there's a tiny fair value gap there, but it's so tiny, it's not worth looking at. So this could be what we're seeing. So I've just shown you on a monthly chart that price can either be bullish or bearish. And you're thinking of duh, Captain Obvious, you know, price up, it goes up or down. No, I'm going to show you in a second that both those ideas can make me money this week. I just have to let the market tell me which of them is right. You see how easy trading can be when you do it the right way? Both of those ideas, the fact that price could be retracing from this level or blowing past this level up to that level, both could be true. One way or the other, I can make money either way this week. And it could retrace from here temporarily. It could do this, right? Market structure break here. Could come back in here. In essence, this could be the move if we're respecting that first order block, right? This could be the move. Fibonacci tool is what I want. Oh, I've missed this. Trust me, I've missed trading. It's been all right. This could be the move. It could use that order block to drive itself back down, right? Into what? A fair value gap. All you need are liquidity. I call them liquidity profiles. Some of you call them price delivery arrays. I think that's ICT's term. I call them liquidity profiles. That's what works for me. In essence, these are the bus stops, the terminuses, the airports of price action. So, order block up there, down to liquidity profile, fair value gap there, back up again. And if we turn this to an expansion fib tool, and we go from up to down in that direction, well, I mean, if you get a retracement to anywhere here, roughly around 38.2, as long as it's not below 23.6, where would you expect it to go to? Well, the first target would be back to 100 and then to 161.8, which just so happens, you see the magic, it just so happens to line up with this liquidity profile here, which is what? Another fair value gap. And so, you know, in the words of the SMT community, we're going from internal range liquidity, those are fair value gaps, to external range liquidity, those are order blocks and highs. And so internal range liquidities are order blocks and fair value gaps, and external range liquidity is old highs and old lows. That's how price moves. So even if we are going to the higher place here, right? I would still expect price to make at least a 38.2 retracement in here, right? At least this, something like this, right? Using this as the order block, the new order block. Also, anyway, let's not even go into that. One way or the other, if I can print one downward monthly candle, let's think about this for a second now. I am expecting, doesn't mean I'm going to get it. And if I don't get it, there's no trade. And it's okay to be wrong. But if all we do is get one downward monthly, if this monthly candle forming right now If that's the only one, if all it does is retrace back down, and we're at the end of the month, actually, so if the next candle, sorry, if the next candle is a bearish candle, if price is technically going bearish over the next 1 month, I have 30 days of trade setups I can take from that. I did this on a monthly time frame. You can do this on any time frame and drop down to a lower time frame. I'm just showing you how I keep in sync with the markets. This is how I keep in sync with what's going on above my time frame. But I really don't need to do this on a monthly chart. I just wanted to show you, because the higher the time frame, the more reliable and consistent and clean price action looks. All right, so now let's do what I would normally do. I would do that in 1 minute. So I'd come down to a weekly time frame, 4 weeks in a month, so they're not that different in how they look. And this is it. This is what we just looked at. This is the story. So consolidation, manipulation, expansion, retracement, target. And then we go into another. Now, according to the street bro science, 2 consolidations means a reversal is coming. I don't know. I don't care. Right? Price can do what it wants. I just need to understand what it's doing so I can tap into it. So this could have been the manipulation, in which case we're reversing, or this is the manipulation, in which case we're coming back down south. One way or the other, I am in a high time frame level of liquidity. I expect a reaction. Also, notice that while price jumped up here and here, this last leg, the first impulse leg, very strong. Look, wide fair value gap, very strong. Second impulse leg, very strong. Third impulse leg, not so strong. And price for the last 1, 2, so let's just do this. For the last 12 weeks has been dancing around that. Okay. In essence, we're at an area where something strong could happen. If there is to be a reversal, like we hypothesized, then we'd be looking for one significant downward candle. And even if that's not the case, look at how small last week's candle was, right? Nothing special, but you would have expected it to be bearish based on what happened. Price pushed up. This is how I analyzed last week, and I'll show you screenshots I took for my analysis last week if we have time. So price took out a weekly high and then died under it. So this candle here told me last week was most likely going to be bearish. Let's look at what last week looked like in the market. H4 chart, every divider is a week. This is last week. Well, was it bearish? Yes, it was. And what would you expect in a bearish week? Price to open. Look at this. In a bearish week, you expect price to open, right? Go up to form a high in the middle of the week. Find a liquidity profile, in this case, an order block here, right? This is the order block here. 1 second, let me get rid of this monthly. All right. Find an order block here. There it is. And short. Simple. Very simple. Also, when it reacted at that weekly level, this is one of my most powerful. I think I got this from ICT, if I'm not mistaken. It's been years now. When I see this on a 4-hour chart, I go check. Listen, If I open my chart and I see this in a 4-hour chart, I go check the high time frame to see if now, in essence, this is the one of the few signals I take that I start looking at the lower chart. And I want you to see every time this happened over the last few weeks, where an intra-week high forms, price cleans it out and breaks structure. What happens? The first time we got from the break of the high, right, all the way down to the low of that leg was 148 pips. Do you think on a 4-hour chart, do you think you could have traded this on a 15 or 1 hour chart? Okay. Let's look at when it happened the other way. The week before, right? 4-hour, Michael calls it turtle soup. Look at that. From not the low of the break, just the level that was broken on a 4-hour chart, all the way up to the high of the leg, 196 pips. Okay? The one before that, let's look at this. Again, we're not talking about catching the top. We're just talking about from that point, when price comes back through it, if you simply take the trade from there using an entry pattern to the low of the move, 100 pips. Bear in mind, these are usually within a week. Usually within a week. And this shows up almost every single week. Look at this. Right? People say, well, why would you show this if you're making money with it? Because when I start having 1 million subscribers on my YouTube channel and 50,000 of you in my paid mentorship, then I'll be worried about giving this away. But at the numbers that I'm doing, even if all of us put all our money, we are not reversing this. The market's far too liquid for all the people who listen to me to change this. Right? And for those of you saying, well, SMC concepts don't work. Well, I'm just showing you. Look at it. Look at it. Again, from here to the high, 160. And if you said, okay, I'm going to stop here, 145. Does this happen every week? Yes. Almost every week, I should say. Sometimes multiple times a week. Right? Let's keep going back. What about the week before? There you go. Intra-week high formed. Price sweeps it. I'm not talking about from the low to the high. No. Because you don't know that this is necessarily the low. I'm saying by the time price trades back in here, you should know what's going on if you know what you're doing. And if you can't see this, if what I'm showing you right now does not make sense to you, I am not insulting you. I am being honest with you, right? I am trying to help you. You have no business trading live money. You should be on a demo. If you're not going aha when you see this, it's a sign that you're not yet ready to trade live money. You will be soon, right? From here up 100. So I'm literally showing you how you can milk the markets for 100 pips a week off just one. Of course, now you got to go to the higher time frame and be sure that you are in the right direction or at the right key level. But if you want to take this past a week, if you want to become a swing trader, right? This is still your trigger. Why? I'm glad you asked. Okay? So let's start with this week in question here. So when this trigger happens, right? Now, if you are an intra-week trader or a day trader, you don't need a 4-hour market structure break for this. You just need to get your weekly and daily bias correct. And when this happens and comes back through the level, you take an entry pattern, any entry pattern you know how to take on a lower time frame. If you want to be conservative, put your stop here. But there are many ways you can trade this with a smaller stop on an intra-week basis. I'll see if I have time to show you this before I close tonight. But if you want to be a swing trader, simple. Just look for a market structure break. There you go. So liquidity hunt, intra-week swing liquidity hunt on the 4-hour chart, right? Market structure break. Pull out a fib, ladies and gentlemen. Pull out a fib. Of course, you also want to know your higher time frame direction. Pull out a fib. Sorry. And mark your order block. Mark the order block this originated from. What do you know? There you go. There you go. Look at that. Look at that. And how do you know that price is reacting to that fib level and order block? The same pattern. Look at that. So if I was a swing trader, I'm not taking this intra-week. I'm waiting for this to return in a week or two. Look for the exact same pattern here, right? There you go. And then again, you have, do you want to be conservative or you want to be aggressive? If you want to be conservative, you wait for the confirmation. Entry there. Stop either here, 50 pips, or here, 60 pips. Swing trader, no big deal. 1-to-1, 2-to-1, 3-to-1, and very nearly 4. If you chose here, a bit more risk, but you lose more, you gain more per win. It'll even out. 1-to-1, 2-to-1, 3-to-1, 4-to-1, 5-to-1 as a swing trader over 3 weeks. It's just, and if you miss an entry, well, simple. For instance, even here, when it comes here, it gave you a re-entry. Look at that. It gave you a re-entry back into this zone here. And so either this or this would have been your trigger. You can now safely, if you see this, you can now safely put your stop here and get your 1, 2, 3, 4, 5-to-1. Just pull out a chart on any pair and see if this works, right? Any pair. Next, of course, this becomes your new swing low. So you're looking for your new swing high. How do you know that it's become a new swing high? Well, you wait for it to break market structure. It didn't break it there, but it broke it there. Cool. Once this happens, you pull your fib. High to low, low to high. Wait for it next week. Below 61. Beautiful. Where now? A fair value gap. And if I showed you this, you would, this is so precise for a 4-hour chart. It's almost unreal. Look at this. From there to there. Boom. It wicked through it. Yes, but it didn't close. It's fine. Look at that. Boom. You see the same pattern here. Beautiful. Now here you have a decision to make. Do you want to put your stop all the way down there? This is such a powerful that again, it's easy to say this post the fact I realize, but this is beautiful. But if you don't like that, okay, it gave you a retest. And this retest should mean that you really safely can put your stop loss there. And again, 1, 2, 3, 4. All right. So, and I caught one of these last week. Like I was paper. My first week back in the market for years. And I could see this. Okay. So Israel, that's beautiful. You're showing me what happened in the past. What about this week? Well, 2 weeks ago, we had this signal bearishly. And in the process, it took out market structure. This is a low that you might not recognize. But even if you don't recognize that one, okay, that's fine. So that there is a swing low. There's a higher candle either side. But definitely, this is structure here. This is structure there. That structure there. That structure there. All right? And that's certainly structure there. And of course, this structure here is the sign we're talking about. Right? This is a sign that moves over this direction. So the week before last was a bearish week. You would expect, like we drew the levels. That's why we started off drawing the monthly and weekly levels. You see the same signals happening here? You see that the exact same thing I showed you on the 4-hour chart happens on a weekly chart. Look at that, right? And on the other end, look at this here. Look at this here. See this? Pew, pew, boom. Look at it here again. Pew, pew, boom. I'm making a sniper sound. If you can't see this, like I said, if you cannot train your eyes, until you train your eyes to spot this, a clean high or low, intra, year, week, month, depending on what time frame you're on, taken. So on a weekly chart, each dividers, in a 4-hour chart, it dividers a week. So you're looking for interweek. On a yearly and a monthly, each dividers, on a monthly or weekly, each dividers a year. So look at that. What would seem to have been a clear low. Okay, let's take this one instead here. And then the market nicks it, but then reverses clearly through it with momentum. Right? Anyway, so we have the same thing here. Even if this fails and it goes higher, like I said, so far, this signal has given us so far 183 pips. I'm saying maybe some more, right? This here is a big rejection. I would like to see price at least come down in here. I can't make it, but it would make sense. Or at the very least, back into this block here. Right? But anyway, so if that's going to happen, it's a hypothesis. We go back to a 4-hour chart. Well, last week, the week opened, made its high, made it slow, and closed back. High and low, not far from each other at all. In essence, pretty much an indecision week. The buyers had and sellers both had their day, but the main meat of the move was selling. So you will notice that this is one of the few weeks where this did not happen. See that? It didn't. It didn't happen intra-week, which is one of the reasons why, in my opinion, it wasn't an expansive move week. However, did you notice this? It did it, but from 3 weeks ago. But I like to see it intra-week. It's a sign that that's a week's move that I can really trust. But I did catch this move anyway. Anyway, so hypothesis. 1, we come back here. 2, we clear here and come back here. 3, we come back into fair value here or here and drop. One way or the other. So we can do that. Or that, based on this. That fairly gap has not been tested yet. Or that. Let me move this one. Right? Or, which I'm not too keen on, but it is possible. It could be that we've already reacted to this fair value gap and are now on our way south. in which case it would be there. Either's fine with me. What am I waiting to see this week? So I'm hoping for a bearish week, is what I'm saying. And if I'm going to get what I want, I am going to wait on a 4-hour chart for a high to be formed. Maybe this high. Who knows? Could it be this high here? That's a nice juicy high. That's a high that has already... The point I'm trying to make is it has to be a high that has shown itself all low as at the time it's been made to be obvious. Let's go back in time. Let's start from here. Right? When you see this, so this low here, right? It looks pretty established. So this low here looks pretty established, right? Price seems to be going up. And then comes and nicks it. And then it goes back through it. And you can draw that line out and it's clear. Right? It's clear. All right. Notice also that it actually took out this as well for added liquidity. And when you see two of them close together like that on anything below a daily chart, just assume, or at least anticipate it going further down. Same thing with here, right? At the time when that's forming, look, those first two candles look almost like an engulfing. It was going up and then came down. Look at this. The same thing here. It looks like a clear reaction, but then it turns around. The same thing here. Look. It looks like a clear reaction, and then it dies. This one, not as obvious, but still, price begins to recede away from it, and then you see that. We didn't get it last week. It was not intra-week, but we did get it here. It's not that obvious, but this is a swing high. This candle is lower. This candle is lower. And if you drop down, let's check this out. If you drop down, say, to a 5-minute chart, let's see, what date was that? That was 19th of September. If you drop down to 1-hour chart, sorry, or 15-minute chart, let's go to 15-minute chart. 19th of September. You see that to anybody trading intraday, that high is pretty obvious. Come on, this is going to take forever. Okay, 19th of September. There we go. That's it. And what would you know? It's actually an Asian high. Look at that. It's the eye of the Asian range, right? So it's a significant high. It's a session high. Significant highs start from yearly highs and lows to quarterly highs and lows to monthly highs and lows to weekly highs and lows to daily highs and lows. Listen, and to session highs and lows. And if you're ultra scalping, if you're doing 1 or 5-minute scalping, you can actually look at breaking each session down, New York and London specifically, into blocks of 4. And you will notice that each of them has their own high or low that is respected intraday. But I digress. So you see, it's a high. It's an obvious high. And if you take into account this here, it's 2 clean highs side by side. Anyway, let's go back to 4-hour chart. Because so technically, the 4-hour chart is, I am trading a 4-hour chart. My signals are 4-hour, but I'm taking my entries on 15 minutes. So my triad of charts, and everybody needs to have your triad. My triad of charts is weekly to 4-hour to 15 minutes. But I'll show you how I use the daily as a refinement tool. You can go monthly to daily to 1 hour. You can go weekly to 4-hour to 15. You can even go daily to 1 hour to 5 minutes. I would not recommend using anything less than a daily chart as your highest time chart. And even that is already uh, on the edge. Some people do 4 hour, 15 minutes, 1 minute. More power to you. That's the kind of stuff that got me burnt out. I ain't doing that no more. Right. So as you can see, this look at this now. Just, this is beautiful. To those of us now, this looks to the untrained trader like this is going to drop. And it might drop. It does drop some of the time. That's fine. But have you noticed that this has now formed? Look at this. 2 clean highs. You can argue that this is Nick. Okay, you know, I mean, if you by the strict interpretation of my rule, this is a high that this is taking up and therefore should drop, and it could work. Experience tells me that there is the chance that this happens. Either to this fair value gap or this fair value gap. And remember, we like to go from internal range liquidity to external range liquidity, or external range liquidity to internal range liquidity. Either's fine. Price here has tapped into an old low. That is external trade liquidity, external range liquidity. We would like it. Ideally, it should be finding internal range liquidity. What do you mean by range? This is the range. From the high of that swing to the low of that swing, that's the range. Right? This here, as when price was here, when this leg was moving, this was the previous range. When that leg was moving from that high there to that low there. It came back in, so it took out something, so it came back in, so that was the range. Once it comes back in and forms a high, this is the new range now, from here to here. But this new range takes out the old range, meaning it's looking for liquidity outside this old range, which is here, here. So I want you to picture this. It first took out the old range itself. That's the first external range liquidity. It's outside the old range. Then it takes out that low. Then it takes out this low. It's still going. The question is, how low can you go? And then finally, this one. Now, this one, which is external, it goes back up. Well, what's it looking for? It should now be looking for internal range liquidity, which is order blocks and fair value gaps inside the original range. What's the original range? Here. From this high here to this low there. And then it is that internal range liquidity that it will use if it's going to if it's going to go further down, great, it will use to continue to push. So, trade idea 1 is this happens. Right? There's a 4-hour intra-week sweep. And if that happens, I'm going to be targeting, let's assume it happens here, and it breaks back down, and my entry order on 15 minutes somewhere here, right? I can put my stop loss there, 25 pips, 30 pips, whatever, to make 80 pips on the other side. Depends on what I see on the daily. I'll show you that in a second. If it's going to continue coming down, it's taking that out already. Where would the next liquidity pool, P-O-O-L, that will create a liquidity pool, PUULB? Well, the next one's here. That's a low, but there is a fair value gap in there. But price has tested it here. Actually drew that wrong the first time. It's tested it here and has now violated it here. Again, the candle closed above it, so you could argue it's still valid. I don't know. I don't like that. It could be an order block, in which case it would be here. Did this order block drive a momentum move? Yes, it did. Fair value gap there. So it could be the other block. It could take out that low altogether and come all the way down into these liquidity pool. Whatever it does, there's a potential signal here. That's if it's going to be a bearish week. If it's going to be a bullish week, then I would then expect this fair value gap here to drive price somewhere here. In a sense, it opens, goes down, and then goes up. In which case, it would then definitely clear these highs here and push up either into this order block or this fair value gap, this order block, or again, completely take this out into this level. And if that were to happen, I would expect price to form an interweek high, interweek low, then push beneath it and go. Or it could simply use this one here. Right? That is a valid. I gotta separate these two guys. That is a now I know it's from the previous week, but that's fine. It's close enough to work. Right? So price could form a low. Then sweep beneath that low. Or use this low, sweep beneath it. The signal is always that you wait for the, you always have to wait for the 4-hour candle to close. This is where many people get it twisted. Wait for the 4-hour candle to close above that sweep. And if it's in line with your bias for the week or the month or the day, you go. So, daily chart. Right. There's too many annotations here. Okay. All right. Let's get rid of this. How long have we been going? An hour and a half. All right. I got to stop. Now, I would have done all this in 20 minutes if I was trading on my own, but because you guys here, but that's fine. So I've used the weekly chart to draw what I think the weekly bias is. Short, looks good to me. Could be long. Could be further indecision. But as long as it's not a doji, and even if it is, as long as the wicks are huge. So even if it's, even a doji can give you a wide trading range that week, if the wicks are significant. All right. Okay. So if I think it's a so here I'm thinking bearish at least for a bit. Take out all these lows here, right? Maybe even this one. Who knows? If it's bullish, it has that high to take out again and retest that. That's fine. I told you then 4-hour chart. That's what I'm trading. 4-hour chart. I'll come and look for my signal. If I want to take an intraday, if the week is not showing itself to be clear in a direction, okay, that's fine. I can take a daily trade. For instance, okay, let's start from scratch here. Object list. Get rid of that. Let's get a clean chart. Right, so price is fractal. It'll do the same thing. Okay. First of all, allow me to draw it to your attention. If you're going from the monthly to the daily to trade the daily, can you see this here? That's a clear daily high that was then violated on a market structure break. This is why I'm initially thinking bearish. Again, I don't need to be right. I just need to have light. All right. So, you see, this is the same pattern I showed you, and it happens on every chart, all the way down to the hourly. I wouldn't pay too much attention to this signal, anything under an hourly chart, because it becomes very noisy. And really, I think the 4 hours where I stop with it. But look at that. Clean high in the same period. So here, same month, pushed up, market structure break. Get your fib out. High to low. This is 50. You want to get to at least 50. And notice 50 is actually on the other side of this time. That's fine. I usually like it when 50 is down. I don't too much like it going back beneath that level too soon. And notice here that it's already gone back into that level once. So what do we see there? Just take the fib away so you can actually, I'll leave the fib there to make the point I'm about to make. Ladies and gentlemen, raise your hands if you can spot this. What is that? It's a daily fair value gap. Now, it's not the kind I like. It's one-sided. And one of the candles is an indecision candle. But still. Also, if you trade early SMT concepts from ICT, that, ladies and gentlemen, is a classic breaker candle. Now, it's not obvious because you might not think of this as a high, but it is. One candle either side. In fact, this has two candles either side, which is really good as a high. So it looked like there was going to be a reversal, right? It looked like there was going to be a reversal. This just picture how to spot breaker candles is they would have looked at the time they were forming potentially like an order block. That looks like a reversal there. Looks like price is going to make another higher high. All right? It looks like price is going to make another higher high, and then it betrays you. It does a Judas swing. Also, if you look at the macro picture, still on the 1 hour on a daily chart, that in itself, not that one there actually, this in itself is a breaker. But because of the structure itself, if you just took this, because that's a very heavy indecision candle, this is actually a valid way to look at it. Don't at me. You do what works for you. I'm telling you how I've traded. And if you look at this, give you an example of what I mean. If you split this candle in half, this zone here in half, I want you to look at every single time price reacts to it. Let's not count that, but look at this. Look at this. Look, 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 right? This is obviously a significant zone. Whether you're taking that, and when you see these zones converge, when you see fair value gaps and breakers and order blocks converge in the same area, you're thinking, okay, something's going on here. Somebody knows something, right? So we would look on a normal week for the high of the low, or the high or the low of the week. This is early ICT stuff. The high or the low of the week to form on a Tuesday or Wednesday. Just go back through cable and fiber. Last 10 years, 6 times, 7 times out of 10, the high or the low of the week forms on a Tuesday or Wednesday. and it will usually form in London or New York. So and you see, this is actually rejecting. Now, Friday was a tepid day. Today, Monday was not a we usually love Monday to be a consolidation, because Monday being a consolidation tells us that we're looking for a move on Tuesday or Wednesday. Monday was not a consolidation. I mean, you can kind of argue it was, but it was a consolidation with a clear direction. So these are the zones. We're already in one zone. There's another zone above us. And if you go down to 15 on an hourly chart, you can start to refine. 1 second. Let's get rid of this. You can start to refine your fair value gaps and order blocks even more. For instance, this here on anything on the 4 hours. I told you I love this. You have an indecision candle followed by, so that's, just get rid of the order block. So the breaker block there, so you can see this clearly. This is a fair value gap here, right? Also notice that this fair value gap is forming at the level of a previous daily high. Remember, I told you 1 hour daily daily dividers that these levels are significant far into the future. So that's a previous daily high from the past. That's a fair value gap there. And just above the fair value gap, right, is an indecision candle. That on a lower time frame, I can guarantee you would have been an order block. So it's possible that at some point tomorrow, Wednesday, price comes up and then down. Or maybe up and down. I will be looking to see. Again, like I said, it's not about predicting. It's about having an informed guess based on the language of price, such that if it then does exactly what you think it could have done at the time and the level it should have done it, then you can step in and trade. So that's an option. Another option, which is very possible. 1 second, let me just take a screenshot of that, so nobody calls me Captain Obvious afterwards. Let me take a screenshot of that like I did when I was trading last week. Okay. Or should I say paper trading last week? So that's idea one. That's my idea for a down week. Or down day, sorry. Or week. It could be a day, because when I want to. Now, alternatively, if it's going to be an up week, means price is going to first come down, right? Means price is going to first come down. Where is it going to come down to? Well, option one is to use this. It could be this low. This is a 4 hour low. It's not the low of a week, but it's a valid 4 hour low. It could use this one or this one, which was the low of last week, right? Either of the two. Hold on a second, guys. Sorry, my kids coming to say hello. In which case, if this is how it goes, right? 1 second, get rid of that. I hate dots. on my screen, right? If that's how it goes, then if it comes here and then goes up, but actually no, because if it comes here, it would have broken market structure. So if it's an up week, then I don't like it to go there because it would have broken market structure. That's a good spot. In which case, it would be this one. It would either be this low here, but again, I wouldn't even like that. If it's going to go up, if it's going to be an up week, then the lowest level that I'd be comfortable with it is here. So this is a swing low. This is an order block. And this order block it's not obvious, but I'll show you that there is a fair value gap in there. There's a fair value gap there. Look at that there. So it could come in here. This would make more sense to me. Somewhere in this region would make a lot more sense to me. Somewhere around here, right? That's the open of the week. Price comes down into internal range liquidity and then pushes up. And if that's the case, then I'm calling, if it's an up week, I'm calling for it to get to and clear out these double highs here. And one of the reasons is, you notice since this high was formed, it's not being tapped. So there is going to be, and several traders will have moved their stops down from here to here, or put their stops in when they were coming in here. This could all have been engineered to clean them out. We don't know yet. We soon will. It's going to be liquidity in there, right? So this is, sorry. This is the second hypothesis for what we could see this week, right? And whichever way it goes, like I said, my entry signal, or my trade signal, not my entry pattern. Yeah, so my trade signal, a signal tells you there's a trade. Your entry pattern tells you how you enter said trade. Let me repeat. This is why many of you lose money. You need analysis, key levels, key times. Your key levels come from a higher time frame. Your key times are your session times, your London, your Asia, your kill zones, right? The signal is that at a key time, price gets to a key level and does something. That's your signal. At a key level or at a key time, let me repeat, the definition of a signal is that at a key time, price gets to a key level and does something. Something repeatable, something that you recognize or can spot. That's your signal. You then drop at least one or sometimes two time frames. I do two, and look for an entry pattern. What entry pattern? I will show you if we get a trade this week. The entry, because I can't show you a pattern with candles that haven't formed yet. But you now have me showing you and taking screenshots on a Monday that I think I have one of two options at one of two levels in one of two ways, and the signal is the same. 4 hour higher low formed and then very quickly swept and engulfed through. I will then drop down to a 15-minute chart, and there's several options I could take. I could take order blocks. I could take market structure break on a 15-minute chart and retest. I could take a fair value gap. I could take a breaker gap. I could take, what else could I take? It's quite a few options. Fibonacci retracement. But when that happens, the safe stop loss will be on a retracement back into that low or on the original low. The aggressive medium stop loss will be just beneath the high that was rated in the formation. Uh, and the ultra aggressive stop loss would be on a 50-minute chart, a fair value gap or order block that's about 15 to 20 pips, no more than sometimes 10 to 15 or 15 to 20 pips. And then we go. And this is how you maximize your wins. If I expect an up week, why would I cash out here? This is the open of the week. If I expect an up week, right, then I'm looking for price to go at least as high above the open as it went below to form the low. Flip side, if I'm looking, let's see if I can find my let's see if I can find the screenshot I took of the potential the trade that would potentially go the other way. Right. Okay. I think I need to change my setting here. Boy, it's been a while since I. Okay, so that's the wrong one. Right. So that's the potential bullish week trade we're looking at. This is the potential bearish week trade we're looking at. Okay, you can't see it. Let's fix that. Okay, so that's the potential bullish trade. If that were to happen, just realizing, hold on a second there, we don't necessarily have to get up there, you know. There's a fairly there. Okay, one second. There's a fair. I know you. Well, you can't see it. I can't annotate a picture, but there's a fair. You see that there? There's a fair value gap right there. You see that there? And it would have taken out this high and that high without going too far up because this is where the week opened. And if that were to happen, right, this would be a perfect, because this would have been the intermediate high. This is a 1 hour chart. Okay, let's go back and look at it on let's go back here. Okay, so I am going to take off all objects. Right. So just remember, this is the open of the week. This is where price opened. So that's the weekly open, right? In a normal week with wicks, in a down week, you would expect, let's just use, so that's the open. I'm just having fun with this. Just memories of how easy trading became for me back in those days. So if that's the open, if it's an up week, you expect the close to be somewhere here, right? So let's take, you know what? let's take last week's weekly range. Last week's weekly range was 100 and let's call it 170 pips. Divided by 2, let's call it 85 pips. Fine. So let's assume it's equally distributed. It's usually not, but let's assume that the open is right in the middle. Right? That would then be the high or the low. Now, in an up week, the open is usually close to the low. And in a down week, it's usually close to the high. Let's go to weekly chart, show you what I'm talking about. So this, let's take a normal kind of candle, like your average candle. Okay, good. So this here is your average bearish candle. It opens here. You can see the open's closer to the high. What's going on? The open's closer to the high, then it drops low. This is your average bullish candle. See, the open's closer to the low. So when we come here, this is why I trade in triads where one time frame's period separator is another time frame's candle. So weekly 4 hour, daily 1 hour, monthly, daily. So this is this week here. That's the open. We know that for a fact. And my color scheme, weekly lines like this, I put in some kind of purple. Some kind of magenta or purple or violet or whatever. Where are you? Okay. Dark violet. Let's use dark orchid. And I will also, because I don't want it to get in the way too much, I will make it something like this. Okay, so that's the weekly open. If it's an up week, we expect price to find support somewhere beneath it, right? Anywhere from here down. Could be here, here, here. Like I said, if it takes out this low, which is possible. Actually, if it takes out this low, then that's it. If it takes out that low and then breaks structure to the upside, then we're looking for it to really run. You know, think of moves as an arrow and a bow. The further back you stretch the bow, the further forward you're really trying to get the arrow. Right? Okay. So you get the torque on the backside, and then in the backward direction, then it moves. All right. So on the other hand, if we expect a down candle, and I'm not taking Monday into account because Monday is very often a manipulation, right? If we want a down candle, then we expect price to find support somewhere here. Again, it could come up all the way to take out these highs, in which case it's really going to drop. If price takes out those highs and then gives us that 4 hour pattern, then we know that this is shooting. In essence, if the high of the week is anywhere above these highs here, if it gets there, before dropping, then we know we're forming another leg. But even if it doesn't get there, let's assume it just comes into this, which is the point I'm making by this would make more sense to me for your regular down week. Right? You open, You go not too far to make your high, then you come down to make your low, right? You come down to make your low, then you retrace to make your close. In which case, if that is wick, if that's the higher wick, then this could be the lower wick down here. In which case, this will then be the low of said candle. And this would be the body. In essence, your candle would look like this. Wick. Wick. Let's extend this just to give us visual accuracy. Wick. Wick. And then body. And then body. That's how your candle will form, ladies and gents. So, and of course, if that were to happen, then this would be a bullish candle. So let's color it in. That would be a bullish candle. And of course, the opposite is true if it's a bearish candle. So this will be a bearish candle, sorry. And like I said, the opposite's true for a bullish candle. If it was a bullish candle, then this would be reversed. Price would go down. Right? It'll go down. Actually, one second. Let me take a picture of that. So, bearish week. And again, it's taking me 2 hours to do this with you. I could do this in literally 10 minutes per pair. Like boom, 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 boom. Maybe 15 minutes per pair. So, bearish week. Let's take a picture. And then if we had a bullish week, this would then be here. Second. It means we'd open, expect price to trade down, right? And then to trade up somewhere, and if it's bullish, I'm saying we're challenging that and potentially sweeping it to end the week. So I'm just going to put it just above. That's just my hypothesis. I could be wrong. In which case, it would then go up. And then make a high. Make a high. And then find its way back down to close, right? That's it. That's how you would expect a bullish week to go. Now, again, this is Monday, so just ignore this. This doesn't mean it's going up to form a high. This could turn around tomorrow and make a low of the week on Tuesday. I have my ideas on what it will do, but the market doesn't respect my ideas. It moves. I just need to be able to distill what it's doing when it's doing it in enough time to take advantage of it with good risk and money management. So that's a bullish week. And in that case, this comes here. That becomes the body. One second, let's get rid of that. So we can take that guy, put him there. And that guy here. Of course, we don't need this because we're not coloring it in. And then that would be the wick. And this would be the wick on the downside. So the same thing works for a day. If you're day trading, what's your day gonna look like? Where does price open? The beautiful thing about doing this in a daily process is you have the Asian range as your friend. The Asian range on the day in particular of the turn will usually be a range. But again, Asian range entry, 4 hour, just several ways you can do this. So that is a high, when I say high level, I mean penthouse view, panoramic view of how I start the week on every single pair that I'm looking at. And then we go. So I'll see you during the course of the week on this. One more thing to show you before I go. Let me open a fresh. Okay, I can use this one. Okay. Just for bonus points for the cool kids. On a 4-hour chart, can you spot this? Again, like I said, if you can't see this, and it's fine, because I didn't start out seeing this for years. I'd blown over 25,000 pounds of hard money, real live money, before I saw this for the first time. Look at that. What does that look like to you? That's a range. That's a consolidation. So, what's happening here? There's two things can be happening here. One is price is retesting the range to shoot. The other is that this So this is consolidation or contraction. This was manipulation. And this is about to be expansion. Right? This in itself is broken structure. And this is forming back near the top of the range. This is a possibility. And let's look. Based on where price was at the end of last week and even where it is today. Okay, there's liquidity here. Just trying to be tapped. And then I'm talking about external range liquidity, not internal range. And then there's here and here and here and here and here. However, look at this. When a range forms, buyers and sellers will put their stop losses usually on one or the other side. The market has cleaned out all. 1 second. I'll put this in green. The more I look at it, what have I done? The more I look at it, the more I'm forming a sell bias. But I don't care. It could be buy and I'll still make money if I do what I've shown you. Prepare for the potential it's a bull. But so these are all daily highs. These are weekly highs. So the weekly highs are more gold than daily highs. Right? These are the highs of a week, not just a day. The highest high in a week separator period of a 4-hour chart is a weekly high. It's tapped this, tapped that. It took out the high of the range. It formed this, right? And tapped it. And then now it's coming down, right? And remember, this is why you need the higher time frame. We are at a key level. A key level. There's another block, hourly order block, or monthly order block, right there. Right? Right there. Okay. So, all right, that's the one I was looking for. That bullish candle. There we go. All right. Well, there is sell side liquidity here. This is a weekly. That's been tapped. There's many others that haven't. That's been tapped. But this is waiting and this is waiting. These are all inside that original consolidation. And then that's the actual low of the range, which many dumb money traders would have put their stops at. And there's that. And there's even that. There's even that. And it may not be that obvious, but that's the so I like short, but I'm not God. I'm not a market maker. I'll be ready for long, but the more I look at it, the more I think short looks good. But we'll see. All right, guys.
go.